Hi guys, and welcome to the video. Hope you guys have been doing okay. I'm just gonna kind of jump right into it today. So, as a lot of people may have noticed, the markets have fallen in the recent week. It's about an 8% pullback, which is, it's normal to see in the market. A couple different reasons why. I mean, one reason, it's not the biggest reason, but the Senate did fail to pass their most recent stimulus bill. It's about a $300 billion bill. Unfortunately, Democrats, Republicans can't get along. I don't want to talk politics. It unfortunately didn't happen. So as a result, because there's no longer this liquidity that people were expecting to get pumped into the market, as a result, markets might fall a little bit. I don't think this is the main reason. I just think it's a combination of things. Also, we can see continuous jobless claims have kind of stagned out. We're sitting at around 13 million people unemployed still, which is historically still extremely high, but it's unfortunate because we're not really seeing that dramatic decline that we saw the first couple months in June and July, and then we saw this little uptick, and it's been pretty flat recent. I mean, if you want to compare to like historical averages, you can see even at the peak of like the Great Recession, 6.5 million people. The dot-com bubble, we had 3.5 million people. So the unemployment rate is still ridiculously high, and hopefully that'll start going down. But because that's kind of slowing down and showing that the economy isn't recovering as fast as people thought, and the money that was being flooded into the market kind of resembles something that a little bit was overvalued. The main contributor why the markets are falling is tech. Tech has been killing it. They have just been on a run nonstop. Let's just look at the XLK. So the XLK is the technology sector. This is going to have the big names Apple and Microsoft are 25%, I think, of it. But even just go to on a year performance. I mean, we'll just go back to January. But you can see the stock was at $91 a share, and it's rallied up almost above 50%, and it fell, and that's kind of expected. I mean, these stocks have been moving in a fast, rapid pace up ever since the market crashed back in March, and their businesses haven't really been affected. So people have been flooding money into them. Not just retail investors like me and you, but smart money, big trust funds that they've been buying call options, which just means that they're betting that the stock's going to go up. And as a result, when you have a lot of money betting that the market's going to go up, they usually do. If we're talking, tens of billions of dollars. But nonetheless, stocks have been on a tear. I mean, we can look at like Apple, for example. Apple has fallen about 15% from its high, but this is, again, we're paying a multiple of 34, which is historically extremely high for the stock, and it's just really high for the market in general. Apple did, hit a most recent landmark of having a market cap of $2 trillion, which has never happened before. They've officially become the most valued company in the world, even above Aramco, the Iranian oil companies, which is, it's remarkable. But again, if you look at the historical price to earnings ratio of Apple, it's closer to 15. So you can say that, I'm not saying they're a bad company, because they're not. They're a great company. They have great earnings. They're still growing dramatically. They pay an okay dividend. But what it comes down to really is that you're looking at a company that has gone up so much recently that if you were to buy the stock now, you're going to be paying the most expensive price the stock has ever had. So that's the way I want people to look at the market. It's not that, it's not like you shouldn't invest in tech, because tech is clearly going to be a part of our future for a long time. But let's be realistic with prices, right? Because stocks go up and down. They always do. They fluctuate. They breathe. They go up and they go down in big waves. And then recently we've seen this 15% pullback in Apple. And because we saw kind of a flat and slightly lower day over this last week, chances are, historically, September's a really slow month. So if it's going to be a slow month, then we should expect that it's likely that these stocks are going to continue to fall. They can bounce around a lot because we are dealing with a lot of volatility. It is an election year, so they could go up 2% on Monday and they could fall 4% on Tuesday. That's all I mean by volatility. It's going to happen, and it's inevitable, so all we can do is try to prepare for it. But yeah, I like, personally, for me, I will probably be buying Apple if they pull back another 5, 10, 15%. I would like to see a little bit more of a price drop before I'm willing to buy in, because I don't personally own any Apple shares. I mean, I own a bunch of index funds that hold Apple, but I don't own them in particular. And it's a stock that I would like to own. And another stock to talk about is Tesla. So Tesla, unfortunately, they got snubbed with their pick to be in the S&P 500 for a couple reasons. One of the big ones being that in the last 26 months, they've only had 4 months of profitability, which is not a good thing. And just to mention, like year to date, this stock was on a tear. It was at one point 480% year to date. That is insane. Even with that most recent drop of 34%, their current year to date performance would be still 283%, but they've jumped from there. So they're still up 300% since January. That's insane. Again, is another example of a company that it's a great company, and I think that they're going to be around for a long time. But I can't justify paying these prices for the company. If you're a shareholder, you probably feel really good right now. One thing I would say is if you've invested in this company anytime in the last 9 months to 2 years and you've seen these kind of gains, you have to really consider what point do you decide to take a profit. Because a lot of people, they buy into a company, they buy a stock, it goes up 30%, they don't know what to do. And really that should always be part of your plan. If the stock moves like it has with Tesla, you don't get these 1,000% returns in 1 year very often. So I'm not saying don't invest in the company or sell all your stock, but what you could consider is selling the equivalent of the principal you put into it, taking a little bit off the table, cashing in some of those profits, because you don't see this kind of performance very often. And now the company is valued at $350 billion, as we see right here. This stock, you can't see 1,000% return next year. It just doesn't happen. You can't have that kind of growth. Otherwise, this company will be worth trillions upon trillions of dollars. So it's a company that has just very recently started making money. They have a lot of potential, but a lot of their income is also a product of selling tax credits to other automakers. Some people might not know that every automaker is required to have a certain amount of electric vehicles produced, and they get these tax credits for it. But because a lot of these big companies don't have their electric vehicles built out, they ended up buying these credits off Tesla, which increases Tesla's bottom line. But realistically, it shows that the company's not really that profitable. I mean, you look, we're paying a price-to-earnings ratio of almost 1,000 still. The market's trading at a price-to-earnings ratio of 25. If you want to compare it to the technology sector, that's somewhere in the 30s and 40s. But still, that's ridiculous. I mean, this company, that means for every $1,000 you put into this company, they're going to make $1 of profit. That's the trade-off doesn't make sense. That's a 0.01%, or it's it's 0.1% of a return. You can't do anything with that. So, like I said with Apple, it's not that it's a bad company, but you can't expect this to continue to last. And just paying these prices, you have to value your money a certain way. If you want to speculate, you want to be buying in, you bought in this most recent dip, and I understand, that the stock fell 34% in 3 days. I totally get wanting to dip your feet in it and watching it climb. But I would also say don't expect to see this accelerated growth we've seen where the stock goes up 300% in a few months. It's just not going to happen again. So that being said, I could be wrong, and if I'm wrong, I'll talk about it. Anyways, guys, I don't really have anything else to share. I hope you guys are doing okay, and hopefully I'll post another video at the end of this week once we see some change in the market. But until then, cheers, and hope you guys have a great weekend.